Hey everyone, in this video I want to talk about trading and how we can approach it like a casino. Now, you might be thinking, what does a casino have to do with trading? Well, casinos and trading actually have a lot in common when it comes to risk and reward. When you go to a casino, you're essentially taking a risk with your money, and if you win, you get a reward. Trading works in a similar way, but instead of betting on a game of chance, you're betting on the stock market. So, when we talk about trading, we need to think about our logic and thought process when making trades. We need to have a strategy that is based on sound principles, and we need to be disciplined in our approach. Just like how a casino has a strategy for making money, we need to have a strategy for making profits in trading. The first thing to understand is that trading is a game of numbers. To be successful, we need to understand the mechanics and logistics of how the stock market works, and we need to use that knowledge to our advantage. This means having a clear understanding of the market trends and knowing when to enter and exit trades. Now, let's talk about how we can approach trading like a casino. As we all know, casinos make money hand over fist, but have you ever stopped to think about how they do it? The truth is, casinos have an edge over the players, and they want to keep that edge as long as possible. In order to do that, they use a variety of tactics to keep you playing, even when the odds are against you. One of the key tactics that casinos use is the concept of probability. They know that certain games have a higher probability of winning than others, and they use that knowledge to their advantage. For example, let's take a look at roulette. This is a game where the player bets on a number or color, and then a ball is spun around a wheel. If the ball lands on the number or color that the player chose, they win. Now, when you look at the payout structure for roulette, you'll see that the odds of winning are not in your favor. For example, if you bet on red or black, the payout is 1-to-1. This means that if you bet $1 and win, you get $1, but if you lose $1. This might seem fair, but when you factor in the probability of winning, you'll see that the casino has an edge. In European roulette, there is only one green zero on the wheel, which gives players a slightly higher probability of winning. However, in American roulette, there are two green zeros, which means that the probability of winning is even lower. Even though the payout is 1-to-1, the likelihood of winning is only around 47 to 48%, which means that the casino's edge is somewhere around 2.5 to 3%. Now, this might not seem like a lot, but when you consider the number of times that the game is played, the casino can make a lot of money. And that's the key to understanding how a casino operates. They don't want to take all of your money at once. They want you to stay and play for as long as possible, and they want you to do it with a small amount of money. This is why casinos have table limits. By placing a limit on the amount that you can bet, they increase the number of plays that you'll make, and this increases the house edge. The longer you play, the more you stand to lose, and that's why it's important to know when to walk away. The casino industry intentionally encourages players to make frequent plays and bets, even with small amounts of money. If a player were to try to place a one-time bet of $1 million on red in a game of roulette, most casinos would refuse because they know the probability of losing such a large sum in one swoop is too high. Instead, they prefer players to spread their bets over many plays, limiting the amount of money that can be wagered at one time. This is because the more a player spins or rolls, the greater the likelihood of losing. Even a single spin has an average 51% chance of putting the player behind. Over the course of 100 spins, that percentage jumps to 64%, and over 10,000 spins, it becomes impossible to retain any initial winnings. The longer a player continues to play, the less consistent their results become, as the small edge the house holds over them, of around 2.5% to 3%, slowly but surely returns to the casino. Traders, particularly options traders, can apply similar principles in their own businesses. They need to make high probability trades and keep their position sizes small. They should approach trading like running a business and make small, informed bets based on their position size. Consistency is key to success, making high probability trades with small positions over a long period of time. Traders shouldn't expect immediate profits from one or even 100 trades. It may take many more trades to achieve consistency and profitability. Experienced traders who remain consistent and persistent over time tend to become more successful, just as long-term casino players tend to lose more money. It's crucial to take a step back and understand the big picture of what traders are trying to achieve before getting into the nitty-gritty of trade entry and management. It's important to remember that trading is not a hobby, but a serious business that requires strategy and discipline. By making high-probability trades with small position sizes over the long term, traders can increase their chances of success and profitability. Like a casino, the longer traders stay in the game, the more they stand to gain. By following these principles and staying consistent, traders can achieve their financial goals and experience success in the market. Hope you enjoyed the video, and happy trading!